That's closing bell on Wall Street, and now it's market domination overtime. We're giving you full team coverage of all the moves to get you up to speed on the action from today's trade. Jessica Inskip, Director of Investor Research at stockbrokers.com, as well as Yahoo Finance's Josh Schaefer, joining us here to break down the moves. Josh, I'm going to start with you on that close.
Hey Josh, so we did have all three major averages close today higher. You can see the Dow Jones Industrial Average closing almost 100 points higher, so not a large rally for the Dow compared to where we take a look at the S&P 500 benchmark index rising 0.7% today. And then the NASDAQ composite, a bit more tech heavy in the NASDAQ. We're going to get into that in a second. That was up 1.2%. Couple other movers I want to point out here. We were highlighting this earlier, but the S&P 500 equal weight did underperform today. The S&P 500 equal weight actually in negative territory. That gives you a little bit of an indication of this large cap tech rally that we saw today, not necessarily a broad rally within this market. Similarly, the Russell 2000, which if we go to a 3-day, had been in rally mode as interest rates have been falling over the last couple days. That rally paused today. Index was roughly flat, still up over 2.5% on the week though. A few other things I want to highlight, Josh. Take a look at the VIX. I'm going to throw this on a 5-day for us because one of the key things we had been watching with the VIX, of course, after that weak July jobs report, the VIX had shot up significantly higher. It was above 20. That is a key level that a lot of Wall Street strategists will highlight. You're starting to see volatility come into the market. Look at what's happened to the VIX this week. We've had a much calmer VIX. We have stayed below 20. I know you and Jessica were talking a little bit about the dollar index. So I want to find that on my screen here. Dollar index, again, lower today. If I put on a year to date, we had seen a tiny little bit of a rally over the last couple days in the dollar. Was interesting to see that sort of fail. And I know some folks have been watching the 100 level on the dollar, so that will be one we continue to keep an eye on. A final thing in currencies I'll take a look at, Bitcoin. Bitcoin exchanging hands at about $115,000 a coin, I should say, not a share. And then finally, some trending tickers I want to look at. Got to start with Apple. Apple up over 5%. I mentioned a tech rally that we saw today. We are awaiting CEO Tim Cook and President Donald Trump to be speaking at the White House. Apple, a key driver of the market action. Similarly, when we look inside the NASDAQ 100, large cap tech, again, Apple up over 5%, Amazon closing up 4%. That's reversing a few days of downside action since earnings. And then you take a look at Tesla also catching a 3.5% bid today, Josh.
All right, Josh, thank you. Jessica, your thoughts on the trade today?
Yeah, I think it's nice to see some more upward pressure after we've had that really bad down day from Friday as we're digesting what's happening. But I really think it's going to matter what happens with Apple, especially with that ceiling of resistance at 215. Whatever happens with this Tim Cook and Trump and what's happening there, if they can take us past that ceiling of resistance, that can help carry the market. Because there was one point where Apple was doing that, and again, it leads back to this narrow rally, but that's something that I'm going to focus on based on today's price action, and it's going to be very important to see what happens over the next couple of hours, actually.
For sure. All right, joining us now to talk more about this. We've got David Wagner, portfolio manager for Aptus Capital Advisors. That firm has more than $5 billion in assets under management. David, we got a rush of earnings about to hit the tape at DoorDash and Airbnb and Lyft. I'm curious, take a step back. Walk me through what you make of this earnings season so far. What have you heard? What have you learned?
Yeah, Josh, it's been an absolutely amazing earnings season so far in my mind. I mean, as of right now, I think about 376 of the S&P 500 constituents have reported, equalizing about a earnings per share growth on a year-on-year basis on 11.2%. I mean, you got to step back. Take 30 days ago, we were expecting EPS to grow like closer to 5%. So obviously the bar was lowered heading into this season, given all the rhetoric around, consumer spending and tariffs, but they definitely knocked it out of the park. But the last thing I would say here is those stocks that have beat on earnings, they beat on revenue, just say beat across the board, they haven't really been rewarded. Actually, let's just say in line with average. But I'm actually focusing on the other side of the coin. If a company missed on revenue or if they missed on earnings per share, they've been absolutely annihilated on average by about 8% trading down on the next day after the earnings release. So I think a lot of the names that we have coming after the bell today, whether it's Lyft, Airbnb, App, I think given the low quality rally we've seen in this market, I think these names have a high bar set for them heading into the report.
What did you make of what you heard during the earnings season? I mean, obviously trade and tariffs were front and center. I was talking to Jess early in the show about this. You did hear, I'm not going to say every CEO, but it was a theme to hear CEOs, CFOs come out and say, you know what, we do think we have some ways to mitigate this. There are levers we could pull. maybe it was cutting costs or raising prices, or maybe we could lean on our suppliers more. What did you make of what you heard when they talked about that theme specifically?
I mean, that's the best part about American companies, the numerous levers that they have to be able to pull, keep margins at bay. I mean, that's what I was, Josh, really looking at for earnings season this quarter was the overall operating margin of the S&P 500. Everyone was expecting for them to pull back in the second half of this year, given the exact, rhetoric that you were talking about. But I think a lot of those problems, were put at bay with a lot of the commentaries from the CEOs itself. I think the things that actually stuck out from my perspective on earnings call was actually the optimism around the one big beautiful bill. Of those 376 companies that I said have already reported, about 100 of them already said, hey, you know what, we're going to see a pretty big benefit from the expense nature of CapEx moving forward in the future. That's going to be very beneficial for guidance. So I think, coming out of earnings season so far, I'm actually more optimistic than I was heading into earnings season. And I was pretty optimistic, to be honest.
Jess, it's the big beautiful bill. I had any number of economists come on the show, and when I would ask them, hey, how stimulative is this going to be for the economy? I would say in general, the reaction was kind of muted, but maybe the C-suite, maybe the folks running companies see something different. But what do you make on that trend that David's calling out?
Oh, I would expect that from economists, because the stock market it's a forward-looking indicator of the economy. It is not the economy itself. And I do agree the bar was set very, very low. And I think it's interesting if we're going to see a CapEx reacceleration, that's a positive catalyst. And we measure the stock market by 500 companies, and it's very, very, very weighted now in technology. And if there is an investment there's a broader investment, then there's absolutely room for acceleration. And that's the intent of I like to call it the triple B bill, or the big beautiful bill. If the intent of that is to bring on more spending and to have incentives with company, that is, like I said earlier with technology, it is an influx of cash. Big cap tech got an influx of cash, so they're able to accelerate that spending. And if it's broadening out, like you're saying, that's even better from an earnings perspective from the stock market, which is not the economy.
I mean, Jess, let me make a point here.
Yeah.
You bring up the best point that makes me so optimistic for this market moving forward. I think everyone wants to fade the amount of CapEx that, those 5 companies, so, you got your Microsoft, Amazon, absolutely, plus Oracle. Their CapEx, on a year-over-year basis, close to $364 billion. And I think we have to put that in context. If you go pre-COVID, that was like the average size of a fiscal bill that came out of Washington, D.C., and that's being injected into the market, into the economy. I mean, one man's CapEx is another man's revenue, and I think given the operating leverage characteristics of this market, I think you need to be positive.
It makes sense, and again, from a company perspective, that it's logical. it's a logical move. And also, even I hate when I think we've talked about this before, where we say that the stock market's very overvalued and we're looking from PE perspectives. This is not the same type of stock market whatsoever. If we are comparing it back 20 years, that's not tech heavy. It's tech heavy that justifies higher multiples. We have higher free cash flow, we have better margins, and that is good overall for the market.
Let me ask you, David, so you're constructive on the market, but when your clients ask you, okay, what worries you? What would be on your list, what would be on the radar of concern for you, David?
I think right now, that's a great question, because I do think the ledger sides more to be optimistic. If I was pessimistic, I think it's just an aspect of liquidity right now. I think a lot of people forget what happened with interest rates at the beginning of this year, with the Fed TGA, it's basically the U.S. Treasuries, their checking account. It was taken away from the Fed and into the banking system to the tune of like $500 million. So it's got to get replenished. So their liquidity has to come out of this market. And you couple that alongside some weak seasonality. I mean, the span of August and September tends to be historically the worst 2 months on a back-to-back basis over the span of the calendar year. So I'd say those two things.
All right, guys, we are going to stop now because now the earnings party starts. I want to start getting to some of these names here. So let's see if we can get it. Lyft, just coming out here. Let's see if I can get it. I'm going to hold off on Lyft because I'm trying to bring that one up. That is down 9% right now. Your thoughts, David? Are you constructive on this name?
They just completed that acquisition. It's of the Euro taxi app, free now. And I really want to see what comes out within their guidance, because it's really being included in the numbers for the first time as of August 1st. But, obviously the market doesn't like to move with it being down 9%. The implied move was closer to 14%. So, I think we're going to look at the chart, because I did think the technicals kind of look like it was at a make or break period. But right now it's probably siding on the latter.
Let's get to DoorDash second quarter earnings. They're just crossing the wire as well. Here to help us break that down is Yahoo Finance senior reporter Brooke DePalma. Brooke.
Josh, investors certainly pleased with DoorDash's results. You can see here the stock is up more than 6% in after-hours trading here after the delivery company beat on all key metrics and also delivered on record total orders. Taking a look at those numbers, we had adjusted earnings come in 20 cents higher at 65 cents versus the street's expectations for 45 cents. Revenue also came in higher than expected. You had that key metric come in at $3.28 billion versus the expected $3.17 billion. Also worth noting here that those record total orders, or those increased 20% year over year. Those came in at 761 million, surpassing Wall Street's expectations for 749 million. And their marketplace gross order value, that is both orders as well as those key membership fees like that Dash Pass as well as their international platform Wolt Plus, that also increased 23%. We had those numbers coming in at 24.2 billion versus the expected 23.6 billion. And all of this, all these optimism behind led the company to have a rosier outlook when it comes to the rest of the year. And that certainly has investors pleased. Once again, if you could take a look at the Yahoo Finance platform here year to date, this is ongoing momentum. These shares are up more than 50% so far this year. And if you take a look over the past year, this stock has gotten lots of excitement. It's up more than 100% over the course of the past year.
Yeah, a big move heading into the print, Brooke. What are you listening for on the call?
Yeah, well, after this optimism around the report, after we've heard of a slowdown in this restaurant spending across QSR, I'd be interested to hear more if they are seeing any sort of signs of a pullback in consumer spending. Has there been any changes? It seems as though all income cohorts contributed to the strong report. So what are they seeing there beneath the hood? In addition to that, also potential tariff impact on their international business, which is that Wolt Plus subscription. They did it here with their Dash Pass subscription platform here in the U.S. How exactly is the tariff narrative impacting that international business growth plan there? And lately, state of competition. We know that DoorDash is competing with a multitude of other delivery platforms. And so how are they staying consistent, they're saying? How are they sticking to value and really winning ahead of the competition here?
All right, thank you, Brooke. Appreciate it. Turning now to Lyft as the company's second quarter results hitting the wire. So let's get those to you. Q2 EPS 10 cents. That is versus an estimate of 27 cents. So it looks like we fall short of estimates on that front. Just looking at the top line, Q2 revenue, $1.59 billion. The street was closer to $1.61 billion. Just looking ahead here, they're looking for Q3 gross bookings. They're calling for $4.65 billion. The street was closer to $4.8 billion. And Q3 adjusted EBITDA, $125 million to $145 million. This, you can see the reaction of the stock. We're down more than 6% here, David, in the after hours. What do you make of it?
That's an absolutely very difficult report in my mind. I mean, it was, like I said, I mentioned it was all about guidance moving forward in the future, but it looks like Lyft is going to continue to lose their battle against Uber. I mean, they're already underperforming Uber by 37%. So there's kind of two wrench in the spokes of the tire right now, in my opinion. A very, very poor guidance metric. You know, now you have negative earnings per share growth on a year-over-year basis, and then you just have the continual headwind that they continue to lose out to Uber. So, you know, stock down 8% when I just mentioned when stocks miss on the top and bottom line, you know, they get absolutely crushed by about 8%. Seems like it's right in line with that right now.
All right, let's move on to another name. That would be Airbnb, because those results hitting the tape as well. It looks like a Q2 adjusted EBITDA, Jess, I see $1.04 billion. The street was closer to $970.7 million. I'm looking for top line Q2 revenue. There it is, $3.10 billion versus an expectation of $3.03 billion. Looking ahead, as for the forecast, Airbnb is telling us they see Q3 revenue between $4.02 and $4.10 billion versus consensus of $4.05 billion. That stock basically flat right here in the after hours.
Yeah, well, and that's what the chart is telling me as well. Looking at the longer term view, it actually has this area of resistance and an area of support where it is completely stuck in between. And it is like that for a 3-year chart, which tells me we need a better catalyst than this to move any higher, but also something worse to move lower. There is absolutely nothing happening here, actually, from a price action perspective with the security.
Broadly, you look to Airbnb, Jess, is also obviously a good line assigned to the consumer.
Yes.
How would you broadly characterize the consumer here? How healthy? How resilient?
Well, so I think it was very interesting when we were talking about DoorDash earlier, and immediately we were having a side conversation. It is very difficult to say that we have a constrained consumer if DoorDash has earnings like that. That's a luxury. We can go to the grocery store, we can go to a restaurant rather than paying that higher fee. That makes a difference. Airbnb is a different type of luxury that I would put more to the hotel industry and look at it versus that. And actually even Lyft still is a variation of a luxury in a way, depending on where you live. So I think the consumer, there are cohorts of the consumer that are okay, and I think earnings are also showing that as well.
All right, thank you, Jessica. By the way, thank you for being here all afternoon with us.
Yeah,
We appreciate
no
it.
problem.
It's great having you.
Thank you.
Shares of Opendoor Technologies sinking after reporting a wider than expected loss per share in the second quarter. The move lower comes after shares of the company saw a massive meme-like rally in recent weeks, surging more than 200% over the last 30 days. Much of the commotion spurred by our next guest, that would be Eric Jackson, who announced in July that his firm had taken a position in the company while also voicing his belief that the stock can get to as much as $200 a share. Let's welcome in now EMJ Capital founder and president Eric Jackson. Eric, it is great to see you. So let me actually first get your take on the Opendoor print, because they report, Eric, you saw the stock moves lower. It looks like the Q3 forecast apparently underwhelmed some folks, but what did you make of that print?
They hit it out of the park, Josh, in terms of their trailing quarter, which most companies do. I mean, they sandbag like any good management team does, and they tend to be conservative for the following quarter. It surprised me actually. They guided to basically EBITDA flat in Q3. After this Q2 quarter they just reported was their first EBITDA positive quarter in 3 years, and so one of the questions around this company, and the comparison to Carvana is, can Opendoor get to steady state profitability? That was a question hanging over Carvana 2 years ago. A lot of people didn't believe they could. Turns out they did, and the stock goes from 400 to 3 back to 400. I think the same thing's going to play out with Opendoor, and so, but they're still at the bottom. So that's why I see this as a 100x opportunity. But so even though they guided to like this sort of flat Q3, they also guided very conservatively in terms of their projections. And so I think the market sort of did a sell the news on it. I mean, I don't think it was so bad, but the communication on the earnings call from the CEO and the CFO was really awful. Like, it was just, they were both anxiety ridden. They seemed to show no confidence in the business. And, it came a day after we got the Palantir earnings, and you got this guy, Alex Karp, running Palantir, and they basically fully embraced retail, right? And they and their stock went from $6 to whatever it is now, $180. And then we had this craze in Opendoor over these last 3-4 weeks, and the stock goes from like 51 cents on, I think it was June 21st, to it almost hit $5 on I think it was July 21st or something like that. And then it's pulled back a bit. So almost a 10x rally. And Kerry Wheeler, the CEO of the company, was asked by Bloomberg, what do you think of this retail reaction to your stock? And it sort of saved you from having to do a 50-to-1 reverse stock split. And her comment to Bloomberg was, just sort of like dismissive. It was like, well, I didn't have that on my bingo card for 2025.
Well, she said, Eric, I think she told them we need to, I believe she put it like, we need to harvest this moment, is how she put it.
Right. Yeah. And then I turned on Twitter this morning, or X, and all these people are like, what are we, our organ donors? Like, come on, how about a little appreciation? How about a little respect? The management team didn't do anything to get this thing up from 51 cents to almost $5. It was basically all of us retailers who saw the value in this platform, supported it. We got not a word from management over these last few weeks. So I think she's got to go. I think it was clear she's no Alex Karp. I think it's clear that, she was a fine sort of stopgap CEO over these last 2.5 years. She sort of cleaned up a lot of things. She comes from a finance background. Somebody on X said to me, boy, after listening to her on the earnings call last night, she should be running a REIT, not a
Eric, who should, in your opinion, if she goes, who should replace her?
I don't know, Josh, but I am a huge advocate that Keith Raboy get reappointed to this board of directors.
Why?
Keith
Why? And just so
basically-
people understand, Eric, Mr. Raboy, well-known, well-respected, heavy-hitting venture capitalist. I actually saw on X, you said, if you were on the board of Opendoor, you would call Keith Raboy and say, we need you back on the board. Why? Why do they need Mr. Raboy?
Well, he wrote the original Opendoor business plan like 10 plus years ago. I mean, Keith is a savant. I think he's the brightest guy in tech. He was the Jack Dorsey's, sidekick that really, when Square actually grew, or XYZ or whatever we're calling it now, Block or whatever, that's all Keith. And so he's an operator. Obviously, he's a VC investor now. He's a savant. And so he has been calling for years now that Carrie was the wrong person for this job. He called her the John Scully of Opendoor, and they needed to get rid of her. And so, and I frankly, when I got into the stock, I didn't know how much he hated her. And I was trying to keep an open mind. And because I see value in this platform, no matter who's running it. But after that call last night and just, how she's responded, I don't think she's right. I think Keith would put the right product person, the right tech person in place.
Eric, it is great to see you. I have a million more questions for you. We'll get to them next time. Thanks so much for joining us. Appreciate it.
Thank you.
Well, now we got some breaking news on the Fed just now. San Francisco Federal Reserve President Mary Daly saying Wednesday that the Fed will likely need to lower rates. And here with more, we have Yahoo Finance's Fed correspondent, Jennifer Schonberger. Jen.
Hey there, Josh. That's right. San Francisco Fed President Mary Daly setting the table for rate cuts, saying in a speech just this afternoon, just moments ago in Anchorage, Alaska, that the Fed will likely need to lower rates in the coming months, noting that while tariffs will boost inflation in the near term, the job market is slowing. Daly saying, quote, the labor market has softened. And I would see additional slowing as unwelcome, especially since we know that once the labor market stumbles, it tends to fall quickly and hard. All of this means that we will likely need to adjust policy in the coming months. Whether that means September or not remains to be seen, but Daly suggested that the Fed could look through any increase from tariffs on inflation, saying that, quote, in the near term, we likely will not see inflation come from tariffs in a persistent way that monetary policy would need to offset. And Josh, of course, these comments coming after we saw a much weaker than expected jobs report for the month of July, with revisions downward for the prior months as well. Josh?
All right. Thank you, Jen.